In a historic move, the Federal Reserve just cut interest rates by 50 basis points, suggesting that both the economy and the housing market are going to shift markedly over the next 3 to 6 months. In this video, I'm going to give you all the data that you need to know and understand as a home buyer, investor, or just someone trying to track the economy. Because historically, when the Fed cuts interest rates, everyone, that's the signal that a recession is on the way. Because 10 of the last 14 times that the Fed entered a rate cut cycle, we had a recession. Only 4 times did we dodge a recession. And what a lot of people make the mistake of with Fed rate cuts is they think actually that it's a positive for the economy. For instance, check out this article from September 2007, right before the great financial crash. This article reports how on September 18th, 2007, 17 years ago to the day, the Fed cut interest rates by 0.5 percentage point in an attempt to help the economy, and look at what happened. Stocks surged following the announcement. The Nasdaq shot up 2.7%. The S&P closed 3% higher. This is a good first move that will give aggressive confidence and aggressive relief to credit markets and the consumer. And the stock market actually continued to rally, folks, through October 2007 after the Fed did that 50 basis point cut 17 years ago. And why I'm giving you that example is so you can understand what we're seeing today mirrors very much what we saw at the beginning of that last crash, and that the people who are getting overly excited that a Fed rate cut is somehow going to mean that asset markets are going to go up forever and the economy is going to avoid a recession, these same people existed 17 years ago, right before Lehman Brothers and right before the biggest housing crash of all time. Now, that doesn't guarantee that we're about to see a repeat of 2008. We, of course, need to look closer at what's going on in the economy, because one of the benefits to Fed rate cuts for the economy is that borrowing gets cheaper. Interest rates go down, mortgage rates go down. Mortgage rates are already down to 6.1%. The cost of borrowing a loan for a car goes down. Credit card interest rates go down. So those things will help consumers. However, the early returns, when I polled you guys on if these rate cuts are going to matter, are not so positive. For instance, 6 days ago, I polled you guys and asked, mortgage rates just dropped to 6.1% in anticipation of these rate cuts. Does this make you more likely to buy a house? 91% of you said no. So of the 19,000 people who voted in this poll, think about that, everyone. Sample size of 19,000, which is way more than the official polls that you see in the news. 91% of you are saying lower mortgage rates down to 6.1% does not make you more likely to buy. So I want you to think about that, everyone. One of the main mechanisms for people thinking that Fed rate cuts is stimulative for the economy and the housing market is that it should bring more buyers in due to lower rates. However, an astounding 91% of you are saying that the drop in mortgage rates we're seeing is not doing anything to make you want to buy a house. That should cause you to be very, very cautious in assuming what's going to happen in the economy into the future. Because I see a lot of people potentially making a big mistake out there right now. They're saying, hey, the Fed just cut rates and mortgage rates are dropping. Everything is going to boom. Everything is going to be good. Well, when we look at the data and we look at what people are saying, it doesn't seem to be the case. For instance, folks, what are we seeing on our mortgage applications? This is a data point that I'm going to be tracking every week for you guys to see if there's a rebound in housing market demand. And what we're seeing so far is that there's minimal to no rebound. Through September 18th, the mortgage application index is now up to 146. You can see that's off a low of 131 about a month ago. So a slight improvement in mortgage apps, but as you can see, still at a very low level and still actually 1% below where they were a year ago. So despite the fact that mortgage rates are way down from a year ago, the mortgage apps haven't increased at all. And I'm not saying this to be overly negative. I want to be clear about that, everyone. I'm not trying to be overly bearish here on the housing market and economy, but I just want to give you all a dose of reality about what's happening right now in financial markets, in mortgage markets, with home buyer demand, because it's very relevant in understanding and underscoring the point that interest rate cuts and the prospect of interest rate cuts so far don't seem to be moving the market very much in favor of increasing buyer demand. And if home buyer demand doesn't increase, then I think it's unlikely we see other forms of demand in the economy increase either. And really, one of the things really we got to ask and answer is what's going to happen to this economy over the next 6 months? Because it's clear it's weakening, right? Very clear that the economy is weakening, job market is weakening. It's why the Fed cut rates. But are we going to actually tip into a real recession in the next 3 to 6 months? Because if we do, I mean, all bets are off. on what could happen in terms of downside on stocks and home prices. And to understand this, folks, I put together a chart for you guys, which I'm going to show you here in a second. And this chart breaks down different economic indicators and shows you where we are with these indicators so you can understand firmly how the economy is trending. And, folks, I put this chart together almost as much for myself as you guys because, we continue to hear all these different reports about what's going on in the economy. So what I did is I broke it down between 11 different indicators from different sources and gauge them on if they're strong, normal, weak, or relatively weak. And what we can see here is starting with inflation. We're at 2.5, 2.6% inflation. That's normal for the economy. In a recession, we would typically see more disinflation or potentially deflation. GDP, consumption, those things are strong. So the Bureau of Economic Advisors reports on GDP and consumption. Undoubtedly, these metrics are strong right now, adjusted for inflation. So these are the two things that, how economic bulls are hanging their hat on. That we have strong GDP, strong consumption. Now we go to retail sales from the U.S. Census Bureau, adjusted for inflation, we're at minus 0.5% year over year. That's relatively weak, not as strong. Growth in unemployment, 12.2% year over year. That is definitively weak. It's why the Fed's cutting rates. However, we haven't yet seen a surge in initial unemployment claims from the Labor Department. These ranges are normal. So that's why a lot of people are saying, well, we're not really like in a major recession yet, because while the unemployment level is going up, we're not seeing the claims. Now, some additional data points. Personal savings rate, 2.9%. That is weak. Americans are saving a very low share of their income. The manufacturing PMI, reported by the ISM Institute for Supply Management, is a 47.2. That is also definitively weak, so the manufacturing sector is in contraction. The services PMI, also reported by the ISM, is 51.5. While that's technically an expanding services sector, that number is pretty low, also relatively weak. Finally, loan growth from banks, adjusted for inflation, is minus 0.1%. So adjusted for inflation, we have no growth in loans from banks. And so in totality, you could see the mixed picture on the economy here. And for me, I read that as the economy isn't doing so well and will likely worsen, is how I read those data points and indicators. But I just wanted to lay them out for you as someone watching this channel so you can make up your own mind based on what the data is showing. Because I know a lot of you are looking to buy a house in the next year. A lot of you are looking to make a big financial purchase. And knowing where the economy is heading is very, very important in order to have confidence in that purchase. Because you don't want to buy a big asset like a house or buy a big expensive car and then have the economy go into recession and the prices of everything collapse. I don't think anyone wants that. So it's very important to understand the trends here in the market. And by the way, I know that I have like this light coming on my face right now. It's very annoying. I have the shades drawn, but somehow the sun is still coming through. So please just try to ignore that. But now let's get into some projections, everyone, because the Fed also released some projections on where they think interest rates are heading in the future with these rate cuts. So they just did 50 basis point rate cut. They just did from 5.3 down to 4.8% on the Fed funds rate. So they held the interest rates for about a year and have now cut 50 basis points. What they have projected for the rest of the year is another 50 basis points in rate cuts. So that suggests a 25 basis point rate cut in November and then a 25 basis point rate cut in December, bringing short-term Fed funds to 4.3, 4.4% by the end of the year. So that's the current projection from the Fed on their dot plot. And I think that's pretty likely to happen so long as nothing crazy happens in the economy between now and then. We could still probably see some higher unemployment rate by a little bit. We could still probably see inflation go down by a bit, and they're not going to change that. And what that goes to is probably by the end of the year, a mortgage rate, I would say, a shade below 6%. Maybe it would be at like a 5.9 mortgage rate by the end of the year would be my current projection based on what the Fed is saying. So think about that if you're a home buyer, and I think most of you have already decided that's not going to influence things for you. If you're not going to buy at 6.1%, you're probably not going to buy at 5.9%. Most of these rate cuts are already baked in to the 30-year fixed mortgage rate. And I think what scares me for the economy and why I think 2025 especially could be volatile and the end to 2024 in asset markets is that so many people have been banking on these Fed rate cuts to save the day. I mean, for 2 years, folks, all we've heard is wait until the Fed cuts rates. And now the Fed has cut rates, and we're going to see what happens. Because, you know, my suspicion is not a whole lot is going to happen. I don't think we're going to see much of a bounce back in buyer demand, maybe incremental increase. I don't think we're going to see consumers all of a sudden start spending tons of money just because the Fed cut interest rates by 50 basis points. Consumers are already basically out of money based on record low savings rates and skyrocketing credit card delinquencies. And so, what I kind of fear for people's mentality in asset markets is that now that the Fed is cut, what if things don't get appreciably better? What are people then going to hang their hat on to sustain this bubble? They're going to really run out of options. I mean, this was the big bazooka that was supposed to come in and change everything. And the early returns are saying it's not going to change things nearly as much as people thought. And again, I'm looking at the housing market for this in particular. We can track those mortgage applications every single week, and we're seeing very little home buyer interest in response to these declining mortgage rates. We'll see if the actual announcement of a Fed rate cut causes more buyers to come into the market. I'm somewhat skeptical it will, because I'm also tracking some forward-looking indicators of home buyer demand in addition to mortgage applications, and things aren't looking so healthy. Check this out, everyone. I kind of am putting together a forward-looking home buyer demand index, and I'm combining different data points to do that. We talked about mortgage apps, right, which are down 3% year over year on average for September. They're down 46% from before the pandemic, so we're just nowhere close to a real rebound in buyer demand on mortgage apps. We also see buyer traffic at builder sites is down 10% year over year, 46% from 2019. We also see home searches, homes for sale searches from Google down 16% year over year, 28% from 2019. In addition, Redfin's home buyer demand index, which needs to be updated for this week, is down 7% year over year, down 26% from 2021. So on average, these forward-looking indicators of buyers touring homes, touring builder sites, applying for mortgages, searching on Google, down 9% year over year, 40% from 2019, 43% from 2021. So going forward for you guys out there, I'm going to be updating these forward-looking housing market metrics every week, so you can have a handle, if you're a buyer, investor, or realtor, on if there's like an actual movement in the market for more buyer demand. Right now, the answer is clearly no. Maybe that changes in the future. I have my doubts, but I'll be tracking that data for you guys. So make sure to hit that subscribe button if you want this content into your feed in the future. And lastly, everyone, I just want to show you one more graph. One last graph that's just really important for you all to understand, showing how big this housing bubble is in America and showing why the buyers have not come back yet. Because it's not really the mortgage rates that's the problem, it's the home prices that are the problem. And let me show you what I mean by that. This graph looks at inflation-adjusted home prices in America going all the way back to 1890. So we literally have 134 years of data on inflation-adjusted home prices in America. The source of this data is Robert Shiller, the famed economist from Yale, downloaded it from his website. So you could see that inflation-adjusted prices here at an index of 293 in 2024, they are at a record high. The only other time inflation-adjusted prices were ever this high was 06. Meanwhile, this yellow line is the long-term 130-year average in inflation-adjusted prices. And you can see we're just way above that, meaning that home prices went up way faster than inflation and incomes and the costs of other goods and services, indicating a bubble. We never saw any bubble like this sustain itself in U.S. history over the last 130 years. I think homebuyers intuitively know this, which is why they're not coming back into the market due to incremental mortgage rate declines. Rather, it's going to take meaningful home price declines for buyers to come back in. Let me know what you think in the comment section below about the Fed rate cut, the big housing bubble, the mortgage rate decline. What are you seeing out there in the economy? If you're a home buyer, a realtor, or an investor, I want to hear your feedback in the comment section. Until next time, this is Nick from eVenture Consulting signing off.